Imagine this. The crypto market is in freefall. Bitcoin's plunging thousands of dollars overnight. Global uncertainty is spiking with economic tremors, shaking Wall Street. But amid the chaos, tokenized gold and stablecoins are quietly exploding in popularity, acting as the ultimate defensive play for savvy investors looking to protect their portfolios. Welcome to the generational wealth community, your pathway from knowledge to legacy. Today, we're diving deep into why tokenized gold and stablecoins like USDT are surging right now, especially in this climate of market uncertainty. We'll break down the fresh data, explore the driving forces behind this trend, and share practical strategies to safeguard your own crypto holdings. Stick around because by the end you'll have the tools to weather the storm and potentially come out stronger. First, let's clarify what we're talking about. Tokenized gold is essentially physical gold that's been digitized on the blockchain. Each token represents a specific amount of real gold stored in secure vaults, verifiable and tradable 24/7 without the hassle of handling bars or coins. Leading players here include Pax Gold, or PaxG, issued by Paxos, and Tether Gold, known as XAUT, from the team behind USDT. These aren't just gimmicks. They're backed one-to-one by actual gold reserves, audited regularly for transparency. Now, the surge is real and backed by hard numbers. As of mid-February 2026, the tokenized gold market has ballooned past $6 billion in total capitalization, up more than $2 billion since the start of the year alone. Tether Gold commands about 60% of this market, with its holdings expanding through strategic partnerships that integrate it into broader financial platforms. Pax Gold isn't far behind, offering similar stability but with deep ties to traditional finance like PayPal and MasterCard for easier adoption. This growth isn't happening in a vacuum. It's tied directly to gold's epic rally. Spot gold prices have surged past $5,041 per ounce, driven by central bank buying, inflation fears, and geopolitical tensions that make traditional safe havens irresistible. Major banks like Goldman Sachs are forecasting even higher, up to $6,000 by year's end, citing ongoing demand from emerging markets and private investors. Shifting to stablecoins, these are the workhorses of the crypto world, digital dollars pegged to the US dollar or other fiat currencies for rock-solid stability. USDT, or Tether, remains the king, with a market cap hovering around $185 billion, making up over half of the entire stablecoin ecosystem. The total stablecoin market cap sits at about $307 billion as of February 13, 2026. After peaking at $311 billion just weeks ago, even with a slight recent dip of around $3.3 billion, largely from USDT, the sector has grown massively over the past year, doubling since 2023 and expanding for 25 straight months. USDC, issued by Circle, holds a strong second place with $73 billion in market cap, prized for its transparency and regulatory compliance. So why the surge amid uncertainty? It's all about defense in a volatile world. The crypto market has been hammered lately. Bitcoin's dominance is slipping, with recent sell-offs driven by fading AI hype, broader pullbacks, and tighter Fed policies squeezing liquidity. Investors are fleeing to assets that hold value when everything else crumbles. Tokenized gold shines here as a hedge against inflation and economic downturns. Much like physical gold, but with blockchain perks, instant transfers, fractional ownership starting as low as 1 gram, about $160, and integration into DeFi for earning yields without selling. Stablecoins like USDT provide liquidity and stability, allowing you to park funds safely during dips. 24-hour trading volumes in the billions rivaling major payment networks. Geopolitical fragmentation, declining trust in sovereign debt, and rate volatility are pushing this shift, turning these assets into the new standard for on-chain finance. Institutions are piling in too. Think HSBC and JP Morgan, expanding tokenized offerings for faster settlements and better capital efficiency in shaky markets. Now let's talk strategies for protecting your portfolio. Start by allocating a portion, say 10 to 20%, of your holdings to these defensive assets. Use tokenized gold like XAUT or PAXG to counter inflation risks. Since they track gold's price closely, They rise when fiat weakens. For example, with gold hitting all-time highs, these tokens have delivered steady gains even as altcoins tank. Pair that with stablecoins for immediate liquidity. Hold USDT or USDC to avoid forced sales during downturns, then redeploy when prices bottom out. In DeFi, lend your stablecoins on platforms like Aave for yields up to 5% annually, or use tokenized gold as collateral for loans without liquidating your position. Diversify across chains too. Ethereum for security, Solana for speed, to minimize network risks. Always monitor on-chain data for whale movements. Recent shifts show big players accumulating tokenized gold as Bitcoin takes a back seat. Remember, balance is key. These aren't get-rich-quick plays, but shields to preserve wealth through cycles. As we wrap up, think about how incorporating these into your strategy could transform your approach from reactive to resilient. Subscribe for daily recaps, drop a comment on your biggest takeaway, and turn on notifications. We do a crypto news video every morning and a deep dive every afternoon. Let us know in the comments any subjects you'd like us to cover. Quick disclaimer, I'm not a licensed financial advisor. This is for educational purposes only and not financial or investment advice. Crypto is volatile. Never invest more than you can afford to lose. Do your own research.